Good morning. The multifamily market has officially re entered its discipline era, and the multifamily sector is no longer operating under the assumptions that defined the pandemic boom, where we had ultra low interest rates and aggressive rent growth forecasts and appreciation driven underwriting have given way to a far more conservative and cash flow centric credit environment. And as capital costs reset higher and rent growth normalizes, lenders are recalibrating how risk is measured and which deals deserve capital. And the result is structural shift in underwriting standards that places long-term income durability ahead of the short-term upside. This is not a collapse by any means, it's just a correction towards basic fundamentals. Now, from appreciation to cash flow, a structural shift in underwriting. During the boom years, many multifamily loans were underwritten with an implicit assumption that rent growth would solve everything. And rising values with rapid lease ups and refinancing optionality masked weak operating fundamentals in some deals. And basically, that approach no longer holds true. So lenders are now heavily leaning on discounted cash flow DCF analysis and stress testing income sustainability over longer hold periods. And instead of asking, what could this be worth? Credit committees are asking, what does this asset reliably produce? So, along with that, you can expect some key underwriting changes, and here are a few of them. But lower terminal growth assumptions and higher exit cap rates, an increased emphasis on in place NOI, but also tighter debt service coverage requirements. And this shift favors disciplined operators and exposes assets that relied on optimism rather than execution. So let's look at the barbell effect, strong assets versus weak assets. And recent analysis from TREP highlights just how polarized multifamily performance has become. Rather than steady, uniform net operating income growth across the sector, the data reveals a barbell shaped outcome. And approximately 41% of securitized multifamily loans experienced NOI declines, and over 40% recorded NOI growth exceeding 5%. And the middle is thinning out, is the point. Assets with strong locations, professional management, and realistic rent assumptions continue to perform. Meanwhile, properties burdened by rising expenses, soft submarkets, or aggressive pro forma assumptions are falling behind. And this divergence is forcing lenders to underwrite deals individually and not by asset class reputation alone. So, loan size tells a story about risk concentration. And another critical signal emerging from the data is that loan size inversions. So, larger average loan balances are increasingly concentrated among properties with flat or declining NOI, while smaller loan balances skew towards stronger performing assets. So, this dynamic raises red flags for lenders and investors alike. And what that means is there's a larger loans tied to weaker cash flow, which just amplify the downside risk. And refinancing flexibility diminishes as DSCR compresses. So capital stacks become harder to restructure if performance slips in a property. And in contrast, smaller, well capitalized deals with durable cash flow are proving more resilient, even in a higher rate environment. So, what this means for investors and sponsors? Well, the takeaway is pretty clear. Today's multifamily market rewards operators who underwrite conservatively and execute operationally. And some of the winning strategies right now will emphasize realistic rent growth assumptions, expense control and margin protection, but also opting for longer term fixed rate debt. And more conservative leverage and exit planning is necessary. And deals that pencil only under aggressive scenarios are struggling to clear lender scrutiny. Conversely, assets with stable income and downside protection are still attracting capital, even if returns look a little less flashy on paper. So, this is really a credit recess and not a crisis. And this recalibration represents a healthier long term trajectory for multifamily finance. And by prioritizing cash flow over speculation, lenders are rebuilding discipline into the system. And investors who adapt to this reality by focusing on durable income and realistic underwriting will be better positioned as market stabilizes. And the boom years reward speed, and the next cycle will reward precision. That's it for the day. Please visit my website, houstonrealestatebrokerage.com. Love to talk to you more about your situation, and you can reach out and get a hold of me there. Have a good day.